Next up, we have James Ramelli. He is going to be our next presenter. And give me 1 second while I get him promoted and he gets situated. Perfect. James Ramelli is a trader and options educator at keenonthemarket.com, where he actively trades futures, equities, equity options, currency pairs, and commodities. As one of the moderators of Live Trading Room, Ramelli educates members on strategies, trade setups, and risk management while trading his own capital. Ramelli regularly appears on Bloomberg TV, BNN, CBOE TV, in addition to writing a weekly column for Futures Magazine and being featured in CME's group's Open Markets as a guest contributor. Ramelli holds a BS in Finance with a concentration in Derivatives and Financial Engineering from the University of Illinois at Urbana-Champaign. So, James, are you here with us?
Yes.
Wonderful, James. You may want to turn up the volume a little bit. You do sound a little bit far away, and I'll let you go and take it away.
Alrighty, guys. Hopefully you guys can hear me a little bit better now. I did turn up the volume there. So what we're going to be talking about today is the secrets of a market maker. Michael Lewis in his book Flash Boys really brought into focus what the algorithmic traders are doing, but something that market participants, particularly retail traders, don't spend too much time thinking about is how the market maker thinks and how the market maker trades. And knowing how the market maker thinks and how the market maker trades can greatly improve anybody's trading plan, particularly those who trade equity options. So before we get started here, we have our boilerplate risk disclaimer here. Here at keenonthemarket.com, we are not investment advisors or registered with the U.S. Securities and Exchange Commission. /disclaimer, relatively boilerplate, so I am going to move on here. So a little bit more about me. Thank you for the great introduction, James. Like he said, my name is James Ramelli, and I'm 23 years old. I'm a professional trader here in Chicago, and I was handpicked and taught by our head trader at Keen on the Market, Andrew Keen. I've been working with him for about 2 years now, trading equity options professionally, and within the past 6 months, using the techniques that Andrew has taught me, I have been able to double my account. Now, these are huge, huge profits. And the reason I tell you guys a little bit about myself is because I want to illustrate that this can be done by anyone. These are things that anyone can learn to do and employ successfully. As James said, I'm a regular contributor to CNBC, CBO TV, Bloomberg TV, Fox Business, Futures Magazine, and CME's Open Markets Magazine. So I write and comment on a variety of financial markets through a variety of different media outlets. And I do so all the time. I'm on TV several times a week and write articles multiple times a week for all of these different outlets. So enough about me. We want to talk about why now is the best time in the history of trading for retail traders to be trading equity options. And why is that? We all know that markets have changed over the past 10 years. They've gone electronic, and it has become the best time ever for at-home retail traders to trade. They have a better advantage now than they ever have in the past. Markets are tighter. They've gone to penny wide in many, many options markets, and they're more liquid than ever. Anyone with an internet connection, a computer, and a mouse has access to technology that only used to be available to professional traders. But now, you guys, from home, via a number of different platforms, have access to this stuff. And it makes it so much easier for you to trade from home like a professional than it ever has been. So before we get started here, I want to talk a little bit about what the market maker is. I think a lot of people that trade equity options from home or professionally don't fully understand who the market maker is and what their role is in the market. So we want to talk a little bit about that. Who is the market maker and how do they make money? Well, the market maker is someone who is always quoting a bid-ask spread for any given option contract. Every single line of options in every expiration, weeklies and monthlies for every stock has a market maker who's quoting a bid-ask spread. The market maker is willing to take either side of the trade and is hoping to profit from the spread between the bid and the offer. Let's take a look at an example here. We have Apple trading at $530. The market maker makes a market for the December 550 calls at 25, 25, 30, 20 up. So what does that mean? That means that the market maker at any given time here is willing to buy 20 contracts at $25 and or sell 20 contracts at 25.30. So what happens here? The market maker buys contracts at 25, sells them at 25.30, and is hoping to do that as many times as he or she possibly can to try and profit from that 30-cent spread. Okay, so the market maker cares about number of transactions. They want business. They want order flow. They want there to be a lot of traders trading as many contracts as they possibly can. Right? So the market maker isn't out to get you. He wants your business. The market maker wants you to trade. They want you to be successful so you keep trading and so you keep trading more and more options. Okay? And I think that's one thing that a lot of people fail to understand. We hear all the time that, oh, these market makers are scamming me. I see them trying to run my stops. It's so hard to trade against these guys. But what you don't realize is that you're not trading against them. You're really trading with them. They want you to be successful, and they want you to make money because they want your business. Okay, now this isn't the only way that the market maker makes money. The market maker also makes money on implied volatility. Now, for those of you who may not have a really good understanding of implied volatility when it comes to options, implied volatility can be viewed as the supply-demand curve for any given option contract. Okay, if there's more buyers of the Apple 550 calls in December than there are sellers, implied volatility is going to rise. If there are more sellers than buyers, implied volatility is going to fall. Just think of it like a simple supply and demand curve, okay? Simple as that. There are a lot of very, very intricate formulas and analyses that you can do with implied volatility, but to be honest, as a retail trader, you're wasting your time if you're looking at that, okay? Just think about it as a supply and demand curve. And one of the analogies that we really like here to use all the time is thinking about market makers and their inventory of options like you would a jersey store. It's all about inventory in and inventory out. Store owner is going to keep the store well stocked with hot names like LeBron James, Derrick Rose here in Chicago, because he knows that they will always sell out and there's always going to be big demand for those names. Okay, think about Apple, Netflix, Facebook, Twitter. Okay, these are the most popular names, and the store owner knows that there's going to be bigger demand for them. He also knows that he needs to be more competitive in pricing, and it works the exact same way in the equity options market. Okay, markets are going to be tighter in the more heavily traded stocks and the more popular names, just like Facebook, Tesla, Apple, Twitter, Netflix. There's going to be a lot of competition. Markets are going to be tighter, and the market maker knows that there's always going to be a big demand for those options. Okay, the market maker operates just like the jersey store owner would. He keeps a tighter market and more options on hand for stocks that he knows are popular and heavily traded. Okay, and because he knows this, he has a good read or a better read on what implied volatility is going to do, right? Bids up in implied volatility. The market maker knows there's going to be big demand for these options, so he knows he wants to have more on hand, and he can make money off of the swings in implied volatility in these names. Okay, so the market maker doesn't really care about where you think a stock is going to go. You buy your 5 lot of calls from the market maker, he immediately hedges himself in the stock market to become delta neutral. He doesn't care about the direction, okay? So he's not going to go out there and try to move the stock to run your stops and take you out of your trades, okay? He's looking at a completely different set of metrics than you are. He's not paying attention to the same things, okay? But if you understand what it is that he is paying attention to, you can make your own trading plan even more powerful. Another consideration for the market maker, and this is probably one of their biggest considerations, is time decay. So I want you guys to think about options premiums like an insurance policy that you buy. You might pay your car insurance premiums upfront once a month, maybe every 6 months, and you think that you're really paying it all at once. But in reality, you're paying them a little bit every day. Options are the same way. Okay, if I pay $100 a month for my car insurance policy, I know that I'm really paying $5 a day to get that coverage. So returning to the previous example, when the market maker sold the trader those Apple calls for $25.30, the market maker is hoping to profit off of time decay. Like I said, as soon as that transaction takes place, the market maker goes into the market, hedges himself with stock to become delta neutral. He no longer cares about the direction. Options are the same as this car insurance policy example that we're talking about. That trader paid $25.30 upfront, all of that premium. But really, he's paying a little bit every single day between now and December expiration. The market maker is hoping to collect that little bit of premium that erodes away from time decay from that trader every day from now until expiration. This is one of the main ways that market makers make money, okay? Not by running your stops, not by trying to trick you, and not by trying to scam you on the bid-offer spread, okay? This is how they make money, by profiting from time decay and implied volatility. This is something that a lot of people don't understand. The market maker is not out to get you, okay? The market maker makes money off of you, but you don't even really realize it. They make money off of the bid-offer spread, implied volatility changes, and time decay. They're not running your stops, but if we understand how they're making money off of us, we can use the same concepts to make money off of them. Okay, and we're going to talk about a couple of these examples in depth right now. So before we do that, I want to talk a little bit more about what it is the market maker does and how things have changed for the market maker over the years here, because it's important to understanding how we can use these concepts to take money from the market maker. So all I ever wanted to do in life was be a market maker on the trading floor here in Chicago. As it turns out, the trading floors here are dead. In 1990, there was over 10,000 traders on the floor here in Chicago. Now there's less than about 800. It's a business that's really disappearing. And it's disappearing because the market maker's edge is disappearing as markets go more electronic and as retail at-home traders are gaining edge. Okay, the markets become tighter, the bid-offer spread becomes tighter, meaning the market maker can't profit as much off of that spread anymore. I realized that I wasn't going to be able to make money and be really successful as a market maker on the floor, okay? I have now learned how to use those concepts, though, that the market makers did used to employ while trading behind the screen and take money from them, and you can too. And that's the point that I really want to get across here, is that these are concepts that anybody can employ. Anybody. Whether or not you trade 1 lots or 100 lots of equity options, you can learn this stuff and you can use it to make money. Like I said, I've been able to use these concepts that our head trader Andrew has developed to double my trading accounts over the past 6 months using these trading plans, and I'm here to help everyone try and do the same thing. Okay, now obviously I can't guarantee you guys that you can take this and go out there and double your money in 6 months, but I can help you add some very, very powerful concepts and tools to your trading plan that you have probably never considered before. trading is the best job in the world. If you can become a successful trader, you really have the financial freedom to do whatever you want. Okay? If you can be consistently profitable in markets, you can make your own hours, trade whenever you want, and be your own boss. Part of this new wave of trading and what makes it such a good time to be a retail trader trading from home right now is the fact that anyone with an internet connection and a laptop can trade with the same level of analysis and with the same technology and tools that everyone else can. Right? I can trade from my office. I can trade from the balcony on my apartment. I can trade from the beach. I can trade from anywhere I want as long as I have an internet connection or a smartphone. Right? We have access to markets now like we never have before. So it's more important now than it ever has been to understand how to make money in these markets and to have the most powerful trading plan that I possibly can. So let me talk about our first topic here, which is how to use the market maker's targets against him. And this is something that Andrew has taught me himself and something that I use every single day. And this is something that you can use in any optionable product, be it equities, futures, forex, commodities, anything that has options. You can use this concept to develop targets that the market maker uses every single day. And this is what they're looking at, right? This is how the market maker develops his price targets. So I know that I want to use the exact same method to do that. Okay? And these work better than any kind of fib level or wave patterns, any kind of projection methods that you might use when developing price targets, because they're developed using prices in the actual market, prices that traders in the market and market participants are buying and selling at right now. And you're able to develop these in real time. Okay? And because of all of those reasons, it's far more accurate than any other kind of technical indicator can be when developing price targets. So how do you develop your price targets? Are you using technical indicators like fib levels or wave patterns? If you are, you're leaving money on the table because there's a much more accurate and efficient way to do this, okay? To do this quickly and easily. We can use the options market to calculate how much of a move the market maker is pricing into the options that are trading. So we're able to do this by calculating measured move targets using the price of the at-the-money straddle. Now, for those of you who don't know, an at-the-money straddle is an option spread that consists of long at-the-money puts and long at-the-money calls. The same strike, okay? This is a pure volatility strategy, delta neutral strategy, hoping for large moves in either direction to reach profitability, okay? We're not going to be talking about straddles in terms of trading straddles and strategies and times to make money using this spread. We're simply going to use the price of the at-the-money straddle to develop our targets. But let's talk a little bit about the strategy. Like I said, it's a long call and a long put, the same strike. In this context, we're looking at the money straddles. The main advantage of a straddle is that it has unlimited profit potential. Because you are long upside calls, and in theory, stocks can go up infinitely, this strategy has an unlimited upside profit potential. The disadvantage is that it's very expensive, involves a lot of premium, and a lot of initial capital outlay. The most you can lose is how much you paid for it. The most you can make, like I said, has unlimited profit potential to the upside, and the break-even price is the strike price plus or minus the total purchase price, and that's the point that I want to focus in on here. okay, is the premium paid and the break-even price, because those are the two things that we're going to use to develop these targets. And these are the two things that the market maker uses to develop his price targets. Okay? And I use this for almost 80% of all my trades. Okay, whether or not it's an earnings trade, an unusual options activity trade, whether or not it's a trade, a swing trade based on a technical breakout level in stock, I still always look at the price of the at-the-money straddle to develop targets. Okay, so even if you're not an options trader, if you're a futures trader, a stock trader, forex trader, and have never traded an option in your entire life, you should be using the options market to develop these targets because it's incredibly valuable information for you guys. So once I have that straddle price, I can calculate my targets, okay? So my upside target is going to be the straddle price plus the strike price, and my downside target is the straddle strike price minus the straddle price, okay? So it's the same as my break-even points on that long straddle trade. In general, the shorter time to expiration, the more accurate these targets are. However, I can use them to develop price targets as far out as I want. Okay, if I want to see where the market maker is expecting Facebook stock to be in January of 2016, I can go ahead, go and pull up an options chain, look at the at-the-money Jan Facebook 2016 straddles, and figure out where the market maker is implying the stock can move by that expiration time. Okay? Like I said, in general, the shorter the time to expiration, the more accurate these targets are. A trader can use this for any type of catalyst event. Like I said, my main focus for this is using it for earnings. I trade a lot of earnings. I trade all the earnings here at Keen on the Market for our traders in our live trading room. And every time I'm setting up an earnings trade, I always look at how much they're implying the stock can move on earnings. Okay? And I do that by looking at the price of the at-the-money straddle. When using this to trade catalysts, I want to most effectively isolate the catalyst event, so I'm going to use the shortest time to expiration that still contains the catalyst event. Meaning if I'm trading Facebook earnings, I'm going to use the weekly Facebook straddle that expires in the same week that Facebook reports earnings. That's going to give me my best target. Okay, if I want to trade the unemployment number in S&P futures, either the day before, 2 days before, 3 days before, whenever it is I want to place my trade, maybe even after the number comes out, I look at the price of the E-mini S&P future options, and I look at the price of the at-the-money straddle, and it can tell me what market participants, the market maker especially, is expecting the stock to do, is expecting the futures to do on that unemployment number. Every week when I come into work on Monday morning, I write down the at-the-money straddle price in the SPY, the Qs, S&P futures, NASDAQ futures, Dow futures, and a list of stocks that I like to trade: Apple, Facebook, Tesla, Twitter, Netflix, because this gives me an idea of where they're expecting the market to go that week. Right? Are we expecting a quiet week? Are we expecting ranges to be extended out in huge magnitudes this week? Is there a lot of data this week? Right? Is it a holiday week? Last week we saw very cheap at-the-money straddles because it was a holiday week. They weren't expecting the market to move very much. So I know that I can't be putting on any trades that week where I need explosive moves in the market, right? Because they're saying it's just not going to happen. So let's take a look at an example of a trade that we actually did, and this was an incredibly profitable trade that we put on using this exact same method. So SWKS Skyworks was reporting earnings. the stock was trading around 41 bucks. The May weekly 37 straddle was trading at 4 bucks. So this was a straddle that expired on Friday, yesterday. So with the 37 strike straddle, I am able to calculate an upside target of $41 and a downside target of $33. So Andrew bought, and I bought some of these myself, the 37.39 call butterfly for May weeklies for 38 cents and was able to make over 400% profits over a few days. Okay, this was an explosive, huge winning trade. Right, and for those of you that don't know, butterflies are a little bit more complicated of a strategy. He bought 137 call, sold 239 calls, and bought 141 call, but was able to use that upside target to develop this trade. Okay, and it worked out fantastically. Skyworks went right to the measure move target, and he was able to take a huge profit on that trade. Right, and why does that target work better than fib levels or wave patterns or any other kind of projection methods? Because it uses real-time prices of options. It uses the market maker's implied moves to develop those targets, right? And the market maker knows the stock best, knows how the options trade better than any other participant in the market, okay? Another way that we use the price of the at-the-money straddle is in our Oak Ribbit trading plan. And this is a plan that Andrew has developed over the past 10 years during his career as a market maker on the floor at the SIBO. And it took him 10 years to develop this trading plan. And he used all of the tricks and secrets that market makers use to develop this trading plan and apply it to a retail trading plan that anyone can use. And I think that's a really good point too, is that Andrew and myself are just like you guys, right? We trade from behind the screen using retail platforms that anyone has access to. Andrew trades through Interactive Brokers. I actually trade through Thinkorswim. Okay, but anyone can do this stuff because we use the same things that you guys do, but we use this plan, and that's what makes us so successful and so consistently profitable. So all day long, we watch order flow. We have a proprietary scanner that scans the equity options market to look for unusually large trades that pique our interest. Okay, it shows us what all the hedge funds, big banks, mutual funds, pension funds, sovereign wealth funds, and the biggest traders in the world are doing. Okay, and this is what the market maker stares at all day long. I said at the beginning of the presentation that the market maker is only concerned about order flow, right? The market maker wants to see all of this order flow, and they want to see what big money is doing. Okay, and as retail traders, it's something that most people don't really pay attention to, but if they do, can get an insight to what the big money, what the smart money is doing. How would I feel if I was able to see Carl Icahn's positions before he disclosed them to the rest of the world, or Bill Ackman, or any of these big activist investors or hedge fund managers? Right? Watching the market and watching order flow gives me a clue into what these people are doing. Okay? And we've developed a proprietary trading plan that helps us filter out orders that don't fall into our criteria and gives us the best possible trades. Those trades that are being put on as speculative bets by those big players. Okay, and I'm going to tell you guys exactly what all the steps of the trading plan are here that we use to find these orders and make money off of them. Whether or not the hedge fund trader who's buying a 10,000 lot of calls in a stock that's about to get taken over the weekend had inside information, as soon as his order hits the tape, it becomes public information, and if we can recognize it as a suspicious order and take advantage of that, we've done nothing wrong, and we've profited off of his inside knowledge. So the first thing we look at is open interest. Is volume greater than open interest? Okay? When volume is greater than open interest, we know that it is an opening position, right? We don't want to be trading any closing positions because we want to be getting in when the hedge funds are getting in, not when they're exiting their positions or taking profits, right? We want to get into the trade at the same time as them. This one consideration filters out 80% of all the trades that are hitting the tape as noise, and it cuts down the amount of trades that we have to pay attention to in a given day substantially, okay, and greatly increases the ease of going through all of those trades and finding the best orders. The second step is the chart. Is the chart bullish, bearish, or neutral? What are the strength of the trend into earnings? Where are the gap points? Where is support and resistance? Identifying risk points. All of this helps us determine whether or not we believe that an unusual options activity order hitting the tape is a hedge or speculation. Keep in mind that there are two different types of participants in the options market. There are hedgers and there are speculators. The majority of the market is long. Majority of market participants are long. Pension funds, mutual funds, index funds, they're always buying stocks. They have to buy stocks. Okay, they need to be long the market. Those participants come into the options market looking for protection against their long stock positions. Okay, so when we see huge orders hitting the tape, put buyers, it doesn't necessarily mean that someone out there is getting short the stock via puts and is expecting the stock to collapse. They could be hedging a long stock position. Likewise, when we see a huge buyer of calls, calls can also be hedges against short stock positions. So it may not be someone coming in and speculating that a stock is going to rip to the upside. Okay? So looking at the chart helps us determine whether or not it's a hedge or a speculative bet. Okay? We want to follow speculation, not hedges. Another thing we talk about all the time is R&R, not rest and relaxation. Someone who's a very good trader can find a lot of time for rest and relaxation. However, we're here all the time developing these courses for you guys. But we're talking about risk and reward. How much am I risking? How much can I make? A good trader looks at how much money they can make in a position, but a great trader looks at how much they can lose. Right? I am never swinging for the fences in any one given position. I never have more than 5% of my book in one given contract. It's just irresponsible from a risk management standpoint. Right? I also have a minimum acceptable risk versus reward ratio that I'm going to use for all of my trades. If I'm risking $90 to make $10, I'm going to be profitable 90% of the time. But was it a good trade? Am I a good trader for putting that position on? No, because the one time that that trade goes against me, it's going to blow out my entire account. Okay, so I have to have a minimum acceptable risk to reward ratio, and I need to be very mindful of what that is at all times. Okay? Another thing we talk about all the time, T and T, not tacos and tequila, but time and target. Time is very important. When do I think the move is going to happen? If I see big orders hitting the tape out in December, speculative call buyers, do I want to try and buy June calls? No, I want to buy the same calls that paper is buying, that institutional trader is buying. Keep in mind that options, unlike stock, have an expiration date. We need that move to happen by X date, or our trade is not going to work out. The same time, I need to have targets as well. Where am I going to take profits? Where am I going to scratch out if things are going against me? I need to stick to that plan. Controlling risk is far more important than managing profits. My first goal is to control risk. Manage profits second. Okay? So time and price and profit targets are very, very important to each other, and there's something that I need to be paying attention to at all times. Okay? Remember that the market maker needs you guys. For the market maker to keep making money, they need customers. We're going to teach you guys the ways to start taking money back from the market maker. They're not concerned with running your stops or squeezing you out of a position. If you know their tricks, you can beat them at their own game, and we will teach you how. Andrew and myself have developed this course and have taught it to hundreds of traders already who have used it to become more profitable. Okay, so we want to make you guys an offer right now for the full version of this course, Trade Like a Market Maker. It's going to be held live on April 29th at 7 p.m. Central Time, okay? And these are the topics that we're going to cover. Using the put-call ratios to determine investor sentiment. This is something that the market maker does all the time to determine where the supply and demand is for calls and puts in the market and what the overall investor sentiment is when it comes to options in a particular stock. Using the market maker's targets for iron condors. This is huge, guys. If you guys are credit spread traders and you're not doing this, you are leaving money on the table and you are trading with a much poorer probability of success than if you use the market maker's targets for setting up iron condors and iron butterflies. We're going to teach you guys, Andrew's going to teach you guys how to use those targets to set up weekly income trades, monthly income trades where you collect money on time decay every single day with better targets developed using the market maker's targets. He's also going to teach you guys the best time of day and week to trade credit and debit spreads. Something that most people don't know is that market makers roll out their positions at certain times on certain days of the week, meaning that there is advantages to trading credit versus debit spreads on certain days of the week versus others. There's better times to trade credit spreads. Where can I get the most premium for my credit spread? Where can I collect the most amount of money possible? When during the week? What day? And how do I identify that? When is the best time to buy credit spreads? When are premiums the lowest? When do I get in at the lowest implied volatility level before the market maker rolls all of his positions out? Learn when and why to trade credit and debit spreads. How does the market maker decide whether he wants to be long premium or short premium? What does he look at? How does he know whether or not he wants to be long options or short options? These are things that are very, very important to any options trader. If you are not thinking about these things, if you don't know how to identify these situations, you are leaving money on the table every single time you place an options trade. Last but not least, learn how to potentially profit 600% in options using the market maker's targets. We looked at an example in Skyworks where Andrew was able to profit 400% in just a few days using the market maker's targets. Well, we have strategies and setups that we can teach you guys to profit even more than that. 6, 7, 8 to 1 on your money using these targets to trade catalyst events and other special situations in the options market. We're going to teach you guys how to identify those situations and how you can make money off of them. Okay? So today we want to give you guys a special offer for this course at $97. Okay, if you try to buy this next week, it's going to be more money. It's going to be $197. We will sell out of this workshop at this price level. I guarantee it. And like we said, it is a live course. If you cannot actually attend the live course, it is going to be recorded, and we will make the recording available to you as well. It also comes with 5 hours of additional supplemental materials that you guys can use to learn this stuff and become better options traders. Out of all the people that purchased the course, I would say only 50% of them actually attend it live. Most of them use the recordings afterwards. They're yours for life. You guys get to keep them forever, okay? So don't worry if you can't actually attend the course. We will be providing you the recording afterward along with a ton of bonus materials that you guys can use to develop more powerful trading plans. And like I said, this is something that anyone can do. Any of you guys can learn this stuff. It is not that complicated, right? These are things that market makers have known for a long time and have not shared with other market participants. Okay, like I said, we all worry about what the algos are doing and how they're trying to take our money. The market maker doesn't, okay, because he's looking at something different. The market maker has his own way of trading, and if you can understand what that method of trading is and how you can implement it in your own trading plan, it becomes that much more powerful. Okay, so you guys can go to this link right here, http optionsonthefloor.com/better. To purchase this course, you'll receive a confirmation email right away of your purchase, and this course is on April 29th at 7 p.m. Central Time. Okay, and like I said, anyone can learn from this. And one thing I really want to mention here is that, guys, we have a 100% money-back guarantee on this. Meaning if you take the course and you truly did not learn anything, you give us a call back, we give you all of your money back. No questions asked. Okay? If you guys didn't like the course, if you didn't like the workshop, we don't want your money. Okay? We're not interested in selling you guys snake oil, okay? We have a 100% money-back guarantee here. Out of all the courses that we've ever done, we've presented them to thousands and thousands of people. I think we've only had 3 or 4 refunds out of all of the courses we've ever done. There is value here, guys. $97, we will sell out at this level. Act fast. And like I said, 100% money-back guarantee, okay? If I knew that I could get my money back in a trade, if it didn't work out for me, I would take it every single time, no questions asked. And that's what we're offering you here today, guys.